Hey there. For beginning, myself and Paul just want to remind you that everything discussed here isn't a substitute for formal investment advice and does not represent the formal perspectives of Aquarium Investments. The content of the discussion will hopefully interest you, entertain, and supplement your own perspective, but it's important that you conduct your own research or speak formally to a financial advisor before taking any risk with your money. Having said all that, we hope you enjoy the discussion and let's dive in. Hello, Paul.
Hello, Cormac. How are you?
I'm good. Here we are again, and
Yeah,
looking forward to this episode again. How are you doing?
I'm doing fine. Thank you very much. Looking forward to it as well.
Yeah, it's been 2 months, 2.5 months since our last episode. Today is the 11th of February, 2025, and I think we're going to cover a bit of a range of topics, but pretty relevant as usual. I know today we're going to, I think we're going to talk today about exuberance in the market, I believe, is our key topic, and what you would probably call as irrational exuberance, to do with liquidity and spending and how people are investing into different forms of equity. I think we're going to touch a bit on cryptocurrency and Bitcoin in particular. I mean, everyone following that has seen how it's been rocketing up the last few months. Hey, I think that's what our topics are going to be today. Would you agree?
Absolutely. Spot on.
Sounds good. Sounds good. So, why don't we start off by let me ask you what you think the big changes are, or the big news since this last period of time are, in your opinion?
I would I would point out three things that stood out for me. So one is clearly what's going on in the physical gold market. You know, with the Bank of England not being able to deliver physical in time, there are queues and a lot of physical going to US, to commodity exchanges in US. So I think that's important because it's one thing that was always talked about that it's possible. So that's one. I think what's coming out from the Treasury is important. It's kind of related to gold as well, I think, because Bassett he said in an interview that the asset side of the balance sheet will be addressed and repriced, and in all honesty, it could only mean gold because that's one asset that is being priced at $42 per ounce on the government balance sheet, while we're at 3,000 almost. And I think it basically means that gold is becoming, or, coming back as this major reserve asset for the monetary system, whatever form it will take.
And what's fueling that, do you think, Paul? Is it uncertainty? Is it a fear of inflation again? Or is it that they see volatility coming and that they're suddenly saying, well, we want to reinvest into gold as a hedge against that? Or what do you think is the main driving concept behind that?
So for US, it just means that the asset side of the balance sheet gets a boost. If you reprice gold at, market rates, and you can extrapolate into higher prices as well, obviously, it would give the asset side something like 800 billion straight away.
Wow.
And, it basically beefs up your balance sheet. It kind of prices it to market as opposed to the $42. It was always a weird thing to do, I guess. And I guess the reason why it was mispriced is because US did everything to make gold not a reserve asset and make dollar and the US Treasuries the reserve asset. So
Mm.
that's kind of an admission of what gold really is. And it really is a currency. It's a reserve asset that you can kind of use in trade and in reserves, obviously. And I think we're seeing a big comeback in that sense. If you start thinking like 5,000 or 10,000 per ounce, it solves a lot of debt problems around the world, basically. Look, I'm not saying we're going to hit 10,000 tomorrow, but it's a big shift. And in terms of the importance of news, I think it's definitely important. He didn't explicitly say that it will be gold, but there's not much else out there.
Well, yeah, what else could be in the equation here is I mean, Bitcoin, as we said, we're going to talk about is one that Bitcoin enthusiasts would hope is being potentially maybe a Bitcoin reserve being set up. But alternatively, what else could there be? Is silver an option?
Well, I would say any physical asset could be a reserve. US has an oil reserve, strategic petroleum reserve, they call it. So they have a bunch of oil sitting around in case there's trouble. And most countries do. Russian central bank started buying other precious metals outside of gold this year, I think. I'm sure China has all types of reserves of physical assets. So it could be anything like that. In terms of Bitcoin, well, yeah, that's why we see this premium in Bitcoin price as opposed to tech stocks, for instance, because the industry believes that there will be a reserve and they'll start buying it. The higher level problem with reserves is that typically you make these wealth funds or something like that, or reserves from surpluses, right? When you make some money on trade, or you don't spend as much and you don't have a budget deficit, you have a budget surplus. That's when you have the money to spend on something that you see as stable and for the good of the future. So, but I don't think US is in that situation because we obviously have these huge deficits, and they're not going down, right? They're going up, in fact.
Yeah.
And so with what money, basically, is the question.
Well, that's very fair. I think we're in, as you would call it, potentially this Trump's golden age or the ambition of a golden age, and it seems that he's setting up a lot of things to hopefully push forward on that front. We're probably going to jump into them in a little while, aren't we? But it seems the news is reflecting this kind of talk of reserves and as you said, making the asset side of the balance sheet work a bit more.
So in the third one, we spent a lot of time talking about gold, but the third one for me personally was Rubio admitting in an interview that a unipolar world is a historical rarity, implying that we're heading to a multipolar kind of world. And I think all three kind of these news things, all of them are kind of tied together because gold is the currency of the multipolar world. It would make sense for Americans to move gold back home.
And sorry, Paul, when you say a unipolar world, we're talking about in contrast to what we currently probably have, where there's poles in terms of China as a pole, the Middle East as a pole, US as a pole. A unipolar world would be one dominant force,
Yeah.
as maybe the US would have been post World War II. Am I correct in saying that?
Yeah, exactly.
Yeah.
That's exactly. Well, I wouldn't say post World War II because from 45 to like say 60s, it was a multipolar world more or less. In the 60s, it all changed. It dramatically changed in the 70s when Americans did not deliver their gold, right? And US treasuries became the core and more or less the only reserve asset out there. So, but yeah, it was centered and to a certain extent is centered on US. And by extension, this means the dollar and US treasuries are the instruments of that monetary system. It's very rare for the head of State Department to say something like that. It wasn't a coincidence or something, he was intended. I actually have a feeling that like big get together is on the way and is being arranged, something like Bretton Woods and maybe Plaza Accord or something like that, because it would all tie in, all these pieces would tie into that. And given the proximity of midterms for current U.S. admin, it's likely to happen within the next 2 years, maybe this year. It's a bold prediction, but I do have this feeling. So
Yeah, so it seems like this news that Rubio is coming out about this unipolar world is a historical rarity, as it's put, and then Besant wanting to lean more into the asset side of balance sheet, potentially gold, so on. It seems like there's just a general air of maybe instability from a US side. Would that be kind of what the news is reflecting a bit?
I think for me, it's more of a wind of change kind of thing. The American political situation has not been stable for a while. I
Mm.
mean, it's the opposite of stability, I would say. But in terms of change happening and in terms of steps required for the change, I think these news items are very important.
Fair. Okay, so let's maybe touch on an overview of key market assets from our last podcast. We said last time that we were going to try and include this in every episode as kind of an anchor for the discussion. Gives you an idea of where things are versus the last time. We have such things as US dollar, US interest rates, gold, oil, and a few others. Should we jump into that?
Yeah, sure. Let's do it.
Okay, let's do that.
Okay, so the last time we recorded was 14th of November, right? So the charts are going to reflect the period from 14th of November up to now. Let's start with the dollar index. It's marginally higher since November 14th. It was just below 107 then. It's around 108 now. So not much change despite all the talk from the admin. Gold against dollar. We mentioned last time that we kind of saw that dip as an opportunity, and we turned out to be correct. Gold keeps just grinding higher. It's above 2,900 right now. And, given what we've said, it's likely to go high in my view. I can quickly show a chart. So this chart is doing the rounds on the internet. It's a chart of gold vaults at Comex, which is an American exchange. And you can see the spike in physical deliveries just recently, in recent days. We had the similar situation in early 2020, just as COVID hit. And then the spreads between futures contracts and spot gold widened as well. So, maybe some of this is just arbitrage.
Sorry, so this chart is literally a representation of gold that is being physically moved into vaults.
Yes.
Suddenly there was a huge leap in the amount of gold that was kept in physical vaults, and now it's happening again.
Yes, it's happening again, but it seems to be happening with no recession, no disaster, no virus, no nothing, so something else must be driving it, right?
Mm,
And typically, in recent runs, at least, when there's a large demand, the spreads between derivatives and physical, represented by spot prices, is widening, and it's happened this time around as well. So it's one of those signs, when you want to be long gold, basically. Okay, let's move on. S&P 500 and Nasdaq. They're a little bit higher, a very choppy couple of months. Again, I wouldn't say that these gains are very big. We kind of range bound, I would say, but still a little bit higher despite all the drops. Emerging market stocks, similar picture, big drop down, nice recovery. Most of it is on the back of gains in China. but not just China, not exclusive to China. It's interesting. I did mention that we are exposed to Chinese equity markets. It's interesting that it's the tech stocks that were going bananas in the past couple of months. So, we were buying companies like Xiaomi or SMIC, which is the chip maker, at say 10p, and they within literally months they jumped to 40 or even higher. So a lot of this is driven by China gains, and I think those are likely to continue. So we have a Bitcoin chart and
Oh,
Nasdaq.
this is an exciting addition. We discussed including this the last time.
Yeah, well, we listen to ourselves and our
Yeah,
viewers, right?
yeah, exactly. Yeah.
So again, it's Bitcoin and an ETF that is investing in Nasdaq with 3 times leverage. So you can see that they're pretty similar, right? It's wider than the other charts, right? So we have this from March last year. And you can see how they kind of decoupled in November. Bitcoin is the blue line and Nasdaq 3X is the white line. Bitcoin spiked in November. Obviously, elections were in November, Trump won. And I guess the premium in Bitcoin is due to that, due to the reserve, the stuff we already talked about. But anyway, both are higher since March last year. WTI oil, pretty flat. We went as high as 80 at one point in mid-January. That was short-lived, went back to 70 again, and we're bouncing now. Oil, well, Trump is trying to talk oil down. I wouldn't call his attempt success for now. OPEC Plus kind of refused to play along. They said that their policies unchanged, and their policies basically sticking to the cuts they've implemented before. U.S. rates curve. So again, much like the last time, we're looking at 2 lines. The white line is the curve today, and the blue line is the curve on the 14th of November. You can see how the short side of the curve up to 5 years has pretty much went down, and the longer side of the curve went up. I would say it's a big shift. I expect more of this to be happening. I expect spreads to keep widening. Yeah, so some change here, but generally speaking, rates are still pretty high, right? So despite everything that Min says, Bassett was talking about how he wants to target 10-year rates rather than the Fed funds rate. And it makes a lot of sense because, what we've seen with the Fed's easing policies that they dropped rates, like short-term rates, by 100 basis points, but the 10-year went up by the same 100 basis points. And the 10-year rate is way more important for markets and the economy than Fed funds rate because a lot of things are priced off the 10-year, mortgages, long-term credit, all these things. If they want rates to have an impact, it has to be the long-dated stuff. Okay, emerging market bonds, high overall. I think this shift is very important as well. It seems that bond prices are less responsive to higher dollar, which is a big change. They would typically move inversely.
And why do you think that is that this you're saying it's not responsive to a higher US dollar? Why do you think that is? In a short way, you know?
it can't be answered in a short way.
Fair enough. Nothing we can talk about can be answered in a short way.
Generally speaking, it would mean that emerging market countries are not feeling the strain of lack of dollar liquidity, so they have plenty of dollar liquidity or substitutes, or someone
Hmm.
finances them. So that would be the bigger driver.
Maybe I'm taking a leap in saying this, but maybe it reflects a bit on this commentary about a unipolar world a little bit.
Yeah. Yeah.
Yeah.
So you had cases like, for instance, I think it was Egypt, either Egypt or Tunisia, that UAE financed in a big way. That was maybe 6, 7 months back. So I'm sure China is happy to credit their partners. I think it's something to do with that, but I could be wrong, or there could be other factors, or maybe the market just has a lot of demand for these bonds.
Yeah. Fair. Yeah.
Because, they do pay a little bit more than the treasury say in dollar terms. So if you're positive that the money will be paid back, you might go for that extra yield. Um, the risk you take is debatable, of course, but given where the prices are, I would say there is plenty of demand right now.
Okay, so that's a summary of the markets as they've moved from last time. And it kind of sets us up well for the rest of the discussion on this episode, where we're going to talk now about a bit the US equity markets, touch on Bitcoin a little bit, and the general sense of exuberance that seems to be out there with spending and where people are putting their money. Obviously, as you've touched on there with the Bitcoin Nasdaq chart, Bitcoin has risen exponentially the last few years. It took a bit of a wobble there a year and a half ago, and then it seems to have rocketed up since. And it's hit what, $100,000 per Bitcoin now. I know you and I, Paul, we've discussed this off of outside of podcast discussions, and we both probably have a few doubts about the actual rationale behind that. Obviously, it's returning a lot of money for people, and people are making themselves pretty rich pretty quick off it, which is another matter, and more power to people to do so. But maybe it reflects a general sense of exuberance out there, and then the question kind of overhangs whether the West and US stocks are in a bit of a bubble at the moment. Would that be fair to say?
Well, I wouldn't call all stock markets bubbly, but I would say the American stock market, US stock market, is very pricey. So bubble, for me, it doesn't mean anything. It's just a word that doesn't mean anything. It's abstract.
It's very, very philosophical commentary.
It is what it is, right? I
Yeah.
mean, when I hear bubble, I'm thinking bathroom, all that stuff, or a kid's room or something like that. But you only know it's a bubble once it's gone, when it's done. And there have been plenty of bubbles throughout financial history. The reason why it's worth asking this question, whether, US stocks are too expensive or not, is because the US stock market is so important. It affects a lot of things, like it directly affects taxation, tax receipts in US. So if the market drops, it's bad news for the treasury. And that kind of explains the fixation of many, many presidents and leaders on the stock market.
And we certainly, Trump and co. certainly don't need bad impact on the Treasury because, as we've talked many times before, and on the last episode, we discussed how there's such a deficit to be clawed back.
Yeah, exactly. It's the opposite of what they want. And another thing, Trump wouldn't be winning if, in his mind, he wouldn't be winning if stocks dropped. So he can't allow that. He doesn't want to allow that. But also, it's important because there's so much concentration in the world, especially in US stocks. I've heard numbers close to 70%, 70, 75% of total, market cap in stocks is US stocks.
Mm.
So a huge concentration, which makes this market kind of systemic. For instance, you've just been to Switzerland, right?
Mm.
So I bet you didn't know that Swiss Central Bank, Swiss National Bank holds a bunch of US tech stocks.
I didn't know that.
Another fun fact, you can trade the stock of the Swiss Central Bank, which essentially is a proxy of US stocks. So it's kind of weird that way. But, foreigners own a large chunk of that 75% of total market cap. Given that fact, it's important what those foreigners do. Um, and like for instance, if dollar yuan says repriced and dollar goes up against yuan, it would motivate the Chinese holders of US stocks to sell them, sell expensive dollar for cheap yuan, and repatriate it back home. Same for Japanese, same for Europeans. So it's not just the stocks; it's also the currency, which is also part of a big part of the equation.
Yeah, it's all coupled together. Yeah.
It's all coupled together. It's very systemic on a global scale, very important. So obviously, if you think that it's the market is fairly priced, say, it's a reason to be calmer because everything is kind of in control. But as you get to these large valuations in terms of metrics of stocks, and just in terms of the signs that you see in these markets, it could have implications for other parts of the market. So it's a very important question to ask, basically. I think it's also important to mention that today, in today's world, US stocks and their direction is primarily a function of liquidity entering the financial system. And this means that in certain scenarios, the market could grind higher despite the expensiveness, despite the high valuations.
Just off liquidity, you're saying basically that because
Yeah,
there's so much
just
liquidity, it could continue.
Yeah, and by liquidity, I basically mean money in different forms. So, when the Federal Reserve lowers rates, for instance, generally it's a positive liquidity push. When government is spending money and gives out subsidies, it's the fiscal side of the equation, but it still brings money into the system as we've seen in in all of 24 pretty much. So there are drains of liquidity and stuff like this, but in a scenario where there's a massive fiscal push, or maybe yield curve control, or rates being intentionally pushed lower for a longer time, or just money being given to people uh, in a helicopter money fashion, like in COVID, that obviously translates into purchases of stocks alongside other things, but also stocks and crypto and everything. Yeah.
Sorry, Paul, I didn't mean to interrupt you, but is that I mean, when we saw during COVID, there was, as you called it there, helicoptering money towards people. Is there any reason to believe that outside of disasters and something unforeseen happening, is there any reason to believe that a US administration currently would follow any of those paths that you've mentioned, such as yield curve control, or the helicoptering of money to people, or other angles that would push higher liquidity and therefore the markets higher? Is there any reason to say that they would consider doing that?
I think there are plenty of reasons, and the biggest one is the history of United States.
Okay.
They will try anything. So, especially this kind of admin that we have today, they're breaking all sorts of rules, and I'm sure they could try something. I think direct money to the people is less probable because it's super inflationary. And one of the reasons why they tried it is this belief in modern monetary theory, this economic concept that has no basis in reality. But it was prominent at the time, and it's what they tried post-COVID is basically it.
And what's that theory? Is it just that more money in circulation would mean more spending and more drive the economy?
Well, there are a couple of books written on the topic. So, big, heavy economic books with lots of formula and stuff like that. But the gist of it is that deficits don't matter. You can print at will, spend away, and nothing bad will happen. Well, inflation happens in that case,
Mm.
as was proven post-COVID. It was always this great wall of money that pushed people into buying more goods than they needed, and buying up all sorts of things like secondhand cars and things like that. So it's very inflationary. If inflation is the goal, which they say is not, but who knows, right? Then it's the best way to get inflation, for instance. But yeah, it's very bad for society. I don't think they're kind of scared of it.
Mm.
They're scared of inflation getting out of control, not inflation itself. So they probably won't do it, but doing yield curve control, especially on the 10-year that Besant said he wants to get down. In that sense, yield curve control would just mean buying that duration. And the question becomes who's going to buy it? Who's going to buy those treasuries 10 years out? And, there are options. You can kind of ease the regulation of the banks that would allow them to buy more, and I think that's going to happen. I think there's this thing called the SLR ratio, basically a capital adequacy ratio. I'm sure they're going to change that and allow banks to buy up more, and they'll force them into longer duration. That way, the U.S. Treasury itself is planning and doing buybacks on relatively small scale, but still, it's marginal demand and supply that matters. So they could do that, and at the end of the day, they could monetize on the Fed side, which they have done. They call it QE, quantitative easing. It's basically, buying your own debt with the money you print yourself.
Mm.
So yeah, it has been done before. All of these things have been done before. I'm sure they can be done again in a certain situation. And I guess these kind of policies, they could push stocks higher, not directly, but most of them are liquidity positive, right? So
Mm. Yeah, you're giving the means to people to push things higher, basically. That's
yeah.
the long and short of it.
Exactly. You bring money to the table, kind of thing. The point I'm trying to make is that there are scenarios where stocks could push even higher than they are now. I think it will be difficult, but it can be done.
Mm, okay, fair. And I mean that's what you'd probably summarize as exuberance, this kind of increased
Um,
growth in the price of stocks. Is that fair to say?
it's fair to say, but for me, exuberance in the obnoxious stuff, right? So you mentioned we keep talking about Bitcoin, but what about Fartcoin? I mean, that's my favorite for sure.
Yeah, yeah, or Dogecoin or Trump coin or whatever else. Yeah.
Well, at least Dogecoin, it has a story behind it. Trump coin has Trump behind it, kind of. But what has Fartcoin got behind it?
You
Nothing.
know what? I bought a few years ago because when we talk about exuberance, it's excitement and people getting very caught up in something. I guess that's probably how you'd. I'm sure there's a better definition. If I Googled it now, I could get it off of the dictionary. But to me, that's this kind of theory that people are getting swept up in FOMO. You know, the fear of missing out, and they're investing their money in places that maybe make no sense at other times, but because everyone else is going with it, they're all going with it. And I mean, a few years ago, I bought Shiba Inu coin on some sort of platform, and I was caught at the same time just for a bit of crack. I was like, oh yeah, why not buy some of this coin and see what happens. I mean, it went down to nothing. Like, so I'm pretty sure I turned my small bit of money I put in, turned it into dust. And then I checked on it a few months ago uh,
And it's back.
or a month ago, and it's gone. It's like rocketed up. But I mean, there's no rationale. There's absolutely no rationale for why. And of course, I did the good investor thing, which was I bought high and I sold low. So it's not like I made any money off it. But it just seems there's like a lot of that going on, and I know, yeah, as you said, we've mentioned Bitcoin a few times, and there's a lot of discussion about the theory of Bitcoin and cryptocurrency and its role as a decentralization from the US dollar. But when you talk about the exuberance on these other coins like Fartcoin, as you mentioned, or Dogecoin, or Shiba Inu, or so on, then it starts becoming a bit crazy, right? It starts being
Yeah.
difficult to determine what's actually going on here.
Yeah, it's like, in dot-com times, all you had to do was just say you've got a website, as a corporate, and your stock would skyrocket just because of that. No idea what the company is doing, doesn't matter. Similar to AI today, you add AI to your, mission statement and off you go.
Yeah.
So I would say exuberance comes when you have many of these things at the same time making obscene gains, I was I saw this post on X. So as a joke, this guy was saying that if you had invested in Trump coin, you would have beaten S&P for like 50 years or something like that.
Oh, I saw that. Yeah, actually, I
I
saw
can't
that as
remember
well.
the.
That yeah,
Yeah,
if you'd bought it the morning that Trump was being inaugurated, if you bought Trump coin, you beat
yeah,
the S&P by like 50 times or something like that. Yeah.
yeah, it's crazy.
Yeah.
So
Yeah.
that's exuberance, These days you have these celebrities coming up with these coins, practically scamming people out of money. They pump them, they dump them. They're very open about it, but they still do it.
Yeah,
So
the Hawk Tuah coin, wasn't that another one? That was an example of it. The Hawk Tuah.
yeah, is another example of that. So these things are kind of all over the place. MicroStrategy as well. It's by the way, it's called strategy now.
I saw that. It was a big rebranding. Yeah.
I find it funny. So waiting for it to become MacroStrategy at some point, for sure.
Yeah.
So they're issuing these convertible bonds to buy Bitcoin. And to me, it's such an idiotic concept because, like, if you want to buy Bitcoin, you just buy Bitcoin. Why do you buy a convertible bond of an IT company in US that will buy it for you? I mean, that doesn't sound like a cheap proposition to own
Yeah,
Bitcoin.
you've got a middleman and you're saying we'll pay the middleman and he can go buy Bitcoin. That's basically
Yeah.
what we're doing, right? Yeah.
Well, you're kind of saying the stock of MicroStrategy or strategy will go up more than the Bitcoin itself, and it did for a while. But at the end of the day, you're buying Bitcoin, right?
Mm.
So those are the signs for me. And we could go through a couple of charts related to that. So, for instance, this one It's a chart from Double Line, which is a famous U.S. Wealth manager. They specialize in bonds mainly, but not just bonds. But this chart, it shows conference board consumer confidence, expectation of stock prices increases. And these consumer confidence surveys, they just questionnaires, and people just reply what they think, kind of thing.
It's a public survey, basically.
It's a survey, yeah. And obviously, with every survey or a poll, the quality of the poll is directly related to the quality of sampling, basically. So you always have these questions whether it shows anything, or the methodology was changed or something like that. But assuming that methodology is the same, you can see that literally all consumers, and we're talking retail here, and you can see how extreme this belief in higher stocks is historically. So we're looking at data from 1988, and it's the highest reading ever. Uh, the pink shades are recessions. High readings are consistent with recessions or just prior to recessions. So, it's definitely something to worry about in my book. It means everyone is kind of all in. And this chart from Barclays, it shows you the relationship between economic activity and activity in the markets, which makes sense, obviously. If, economic activity is going up, more money for people to spend or invest, so they invest more. And the red line is the economic activity index. You can see in the chart how it's calculated. And the blue line is the net margin debts, basically how much people borrow to buy stocks. And we're pretty high, right? And it's another thing that you kind of have to be wary of, I think.
But sorry, Paul, before we just jump off that, so it's like consistently high, this net margin debits uh, since 2016, and it just sits up high. And then obviously at the economic activity index, it fell off in 2020 because of COVID. So how would that reflect? Why would you be worrying about that? What does this chart tell us that's notable?
It basically tells you that should economic activity drop, it would mean that there's less money to spend in the marketplace. And for now, the belief in the market is that we are in expansion mode, and this is US data, by the way, right? So it's not global, and we've talked about how investments in US stocks are global. Basically, it's very important for GDP to stay positive, and employment to be kind of where it is right now, growing, and not falling off the cliff. If something bad happens, even a mild slowdown, this will be reflected in the amount of net margin debits, and general activity in the markets. Volumes haven't been great in the past couple of weeks, by the way, in the stock markets, in the US stock markets.
Is that time of year, maybe?
Could be. It could be.
Yeah. People are tired. People are quiet. It's dark.
Sure. Maybe. So we could look at like a couple of metrics. So here's chart 26, and we are looking at PE, price earning ratios, average weighted price earning ratios over the years. And you can see that we're pretty high, have been higher in 21 post-COVID, in 99, 2000. Interestingly, 2008 doesn't register that much. But it's not, these valuations are not cheap. And we could look at CAPE ratio straight away, which is a similar metric, maybe a better metric in my eyes, and it's chart 12. Again, it's not a record. We're at 38.15 now. It was as high as 40.
And just to clarify, because I had to look this up myself for someone that's following along with the charts, the CAPE ratio is a price earning ratio similar to the one you've just shown, but it's unique in that it's an average over trailing 10 years, whereas the regular price earning ratio is from the trailing 12 months. Am I correct in saying that? Just to
Yeah,
distinguish.
yeah.
Yeah.
I think it's just a more objective metric. Um,
Okay, so it's over a longer period of time. It's basically the difference here. Yeah.
yeah. So yeah, again, it's like for me, I want to be buying when this metric is super low. You know, the the lower it gets, the better. Coming back to our Chinese stock exposure again, one of the bigger reasons for us buying into this falling market in China was the valuations, the very low, estimate PEs below 10, sometimes close to 5, alongside dividend yields that were pretty high, like 5 to 7% on average. So, you buy something that is cheap and that is productive because it pays dividend. This is the opposite of that. So for me, it's something that is very, very worrisome. It could easily move higher. So the escape ratio, for instance, it could easily move higher, but there is a ceiling out there somewhere, and it's not far out. And you can see it's actually a pretty good chart because it shows you the average and the and two standard deviations both ways, right? One standard
Yeah.
deviation both ways. So you can see how extreme this is in a historical sense, and it's a long, long chart, right? It's from
1871. Yeah. So it's
1870.
basically saying that people are investing in things um that aren't giving as large a return as they would. If they bought something in 2001 or in 2010, let's say on this chart, the bang for buck on what they invested would have been a lot higher. Whereas because the price earning ratio is so high now, basically they're buying equity into these different companies and not getting as high a bang for buck on the return.
Yeah, I think it just shows that people are happy to pay a premium right now for whatever reason. And I think a big
Mm.
reason for this premium recently, for the past, 7 to 8 months, maybe a year, are two things. One is the fiscal stuff, government spending, propping up the economy, because every dollar that enters the economy somehow ends up on the corporate balance sheet or in wages or something of that type, and it stimulates economic activity, obviously. But it's also all this machine learning AI stuff for sure. It's been like this banner justifying all types of valuations because the argument would go, well, in the future, all these things will be making a lot of money.
Yeah, it's spring the AI discussion. I know we've discussed it in I think the first episode. It's a springboard for many companies basically to say, oh, we're going to be highly profitable and we're going to make a lot of money because AI is the thing.
Yeah. Yeah, so it's kind of this idea, and it's a valid idea. I know you've been early. We've discussed this a number of times, but it's a it's a different proposition when you're early and you invest in this idea early, and when the market is mature and literally every single person out there is talking about it, and it's
Mm.
obviously late, right? And we could look at chart 17, and it's a chart of S&P performance for this year from the 1st of January. And you can see the split by industries. And The orange line is information technology, and it's the only one that is down on the year, just marginally, but it's the only one that's down. So it shows that there's been this rotation to, other sectors of the economy. And it's kind of important because we know that the top 10 stocks, they're tech stocks, they're information technology stocks. So with that said, if this underperformance continues, that could be a drag on the stock indices too. So the valuations are high, the consumer is all in. We can also look at this one. It's number 29, and it's the expected S&P 500 earnings growth chart for 25. And you see how it's fallen from the cliff kind of thing,
Yeah.
off the
Yeah.
cliff. So we have these valuations. Everyone is all in. The hype around AI is questionable
Uh,
to some extent, right? I'm not saying that it's not a great technology, but again, given the valuations and the totality of the S&P 500 index is expected to, the company's earnings are expected to grow less and less, and it seems to be a trend. So, so that doesn't look good.
no,
Um,
you're not painting a pretty picture here when you've got price earning ratios high, very high, nearly record levels, and you've got and that's for both the CAPE index and for the regular price earning ratios, and then you've got a cliff here that you're showing us on screen, uh, where the expectation of earnings is basically falling into the ground. Uh,
yeah.
yeah, it's not
Well,
a
these are expectations, right? So these could
yeah.
be different in reality, but yeah, they're typically are like this for a reason. Um, these are expectations of various
But
analysts and
why,
things.
when you see a chart like this, because I can't help but looking at this and look at what you're presenting with the price earning ratios, why do people not suddenly panic and say, oh, I better start pulling out of like what is
Well,
it?
because what's the saying? The fat lady has to sing, right?
Ah, yeah, okay.
So I can't remember who it was, but it was a CEO of one of the bigger banks during the real estate crisis. And he said, while the music is playing, you got to keep dancing. And that was like 6 months before the collapse of everything and the banking system and, all these bailouts. So yeah, it's very difficult to pinpoint the exact moment when the market reaches its top. I got it wrong before many times, and I would say it's a fool's errand to go short the index uh, until something changes at least. But for now, it's a very kind of difficult proposition because the timing is so difficult. So I don't know by why people don't look at this stuff. I guess the while the going is good,
Keep
keep
on going,
going.
make your money and have a good time.
Yeah,
That's
exactly.
kind of like with the Bitcoin stuff, because I mean, you know, not to round back on it over and over, but definitely for me, there's been like a lot of question marks about the validity of these cryptocurrencies and Bitcoin in terms of long-term play and how viable and how realistically they're going to actually replace primary currencies like the US dollar and so on. But at the same time, you can't deny for a lot of people it's a good way to make money and and a lot of people have made good
Yeah,
money. So why not do that when you can, I
yeah,
guess.
exactly.
Yeah.
So all this reasoning is nothing to a guy who's just made 200x on some,
Yeah.
part
Very
coin
true.
thing. So it's their kind of market. The trick is not to be the last fool standing, and
Hmm.
it's tough to do, right? Especially when you get used to these gains and things.
Yeah, it's like gambling, like going into the gambling hall and you've won on slots and you're like, yeah, Yeah,
Look,
exactly.
I've had interactions with people who, definitely required our services, but they just couldn't let go. They liked the rush. They wanted the feeling of making money, being right, all this stuff, which is alien to me, because it's the the last thing you should be experiencing in the marketplace. But people are people, humans are humans. They do weird stuff. Uh, so I guess that's why. We could look at another chart that you're probably not gonna like, and say that I'm doomsday,
It's
doomsday.
doomsday. Well, like our first podcast was talking about U.S. recession, and and we talked about AI, and I think presented some skepticism on how much returns AI will have for companies. So we're just continuing our trend of basically being very,
Negative.
very, very cautious and negative. Yeah, yeah.
No, no, just super negative. But anyway, let's have a look at this one. So it's chart number 9, and it's basic. It's very interesting. I think everyone should kind of consider this, because and it's chart from the service called Daily Shot. They just aggregate different charts, and it's a chart showing S&P 500 risk premia, which is expressed as as a kind of ratio between forward earnings yield and the 10-year Treasury yield. So without going into too much detail, forward earnings yield is derived from the PE, right? So it's an actual yield that the market is showing now, and it should be compared to the 10-year Treasury yield, because it tells you how attractive the Treasury is compared to investment in the stock market. And the 10-year Treasury, it's a Treasury bond. It doesn't hold much risk. Well, the risk of US default maybe, but then if US defaults, the US stock market is gone, basically. So
Along with everyone else.
yeah, along with everyone else. Well, that's debatable, but trouble everywhere for sure. So, and this chart, it shows it's a pretty wide chart. It starts at 2000 up to now, and it shows you there is zero risk premia given to investors in S&P 500 right now, defined by this ratio. So you're basically not getting paid to hold all that risk. And you can see how non-typical it is historically. It's you should be compensated for risks. That's kind of part of the deal.
So if this were insurance, it would be like an insurance company saying, "Oh well, you know what? We used to pay you for your for weather damage in Ireland, or we used to pay you for um, or we used to insure your house in California against potentially fire damage, but because it's become a more increasing occurrence, we're not going to give you a risk premium anymore." That's
It
kind of the
just yeah, kind of. If you want to use insurance companies as an analogy, I would say it's like saying, well, you pay me the same as like you stay at home, you pay me for the insurance, and it's the same as if you were driving a car, kind of thing. So you're basically not the insurance company is not compensated for the risk, type of thing.
right.
And it's bizarre and it's wrong, because obviously US stocks are way more risky, any types of stocks, than the US Treasury bond, because US government can print money and Apple cannot print money. So, and things can go
Not that we know
wrong
of.
for Apple. Well, no, we do know. Well, yeah, well, I think Meta for sure, they played around with this idea of cryptocurrency, Libra, if you remember. I'm sure Apple had some ideas along those lines as well. But nothing happened. So this is not a good sign either for me. And you can see again, you can see how well you were compensated for risk in the COVID fallout when stocks dropped right in 2020. So, like for me, for someone like me, it's I'd rather wait for an opportunity like that and not be invested than be invested. But having said that, it's not like we don't own any US stocks. We do own some, but those that we consider fairly priced at the moment, and we're happy to add on down moves, you know. But generally speaking, I would say it's not a great time to get into the stock market right now. These are very worrying signs. So, you know, if anyone is listening and they have like a large exposure, and mind you, this is like buying US stocks is like the go-to strategy for anyone who is dabbling in the markets. Like the first thing they will try is buying an Apple stock or something like that, you know. So there's a lot of people out there that have this stuff, and it's probably not the best time to have it, or at least, you know, to be overexposed or have a lot of leverage running on it. I would be very careful.
Yeah, but as long as you're making your money, you got to keep making your money as well. Yeah, you got. Yeah,
It's yeah, I guess I don't think that way, and I don't encourage thinking that way. But yeah, you can't argue against that. But then, you know, it's not my first cycle. So these guys that made all this money, they disappear once the cycle is over. So, you
yeah,
know, and it just rinse repeat type of stuff. So I think you know, it's a good time to finish off. What do you think?
yeah. I think so. I think we've covered a lot of ground again, and summarized well the different angles of exuberance out there, and how they're showing up and what are the indicators. So I think we've had a good discussion again, and hopefully people listening get some insight as well, and they uh, they've learned a few things that makes them think about the way things are out there right now.
That's the idea of this thing, for sure.
Exactly. Yeah, yeah, yeah.
So, are we doing it again?
We're going to do it again, Paul. Paul, keep going, and we'll see what we cover next.
Hmm. If anyone has any ideas, be sure to let us know, and we'll focus on that.
Yeah. Okay. Thanks a lot, Paul.
All right, thanks, and see you next time.
See you next time.